This is the Griffin Podcast, episode number 108. We're in our buyer plan, and the question on the table is, what's the difference between financial pre-qualification and full loan pre-approval? Are you a home seller or a home buyer who has questions about selling or buying residential property? Or maybe you're an agent who needs a plan to run a better business, but all of you are having a tough time finding a way to get your answers. Well, then, hey, you are definitely in the right place. I'm Danny Griffin, the founder of The Griffin and the host of this podcast. And to help you take immediate action to get started in the right direction, if you are a seller, a buyer, or an agent, you can take advantage of our free step-by-step guides that are waiting for you at griffincourses.com. That's Griffin courses.com. You can go over there, jump right in there and get the digital version of our courses and have instant access to education that we highly recommend you take advantage of. No obligation. Just jump in there, griffincourses.com. All right. So what's the difference between financial pre-qualification and full loan pre-approval when you're a buyer? And this is a very important subject because in the last episode, we talked about pre-qualification is beneficial. And I'll use pre-qualification a little bit more than I'll use pre-approval. I'll explain really why those two words work together and what they actually mean to me, in my opinion, which is pretty strong and experienced. So the idea is that we talked about the seller not knowing who you are. So you're a buyer off the street and you come in, and especially in a competitive environment where you might be up against cash. A cash buyer has no mortgage contingency, so the seller doesn't have to have a lot of faith other than a proof of funds and a call to a financial institution to verify the funds. That's a lot easier than waiting for a buyer to go through a full approval process versus being pre-qualified. Because typically, knowing that there is a loan, even if somebody waives the mortgage contingency because they believe there's a high probability that they can close and get it done, seller knows that and might be suspicious and just not want to take the deal. So let's talk about this. What does this process actually look like? Well, first of all, a pre-qualification to get a loan, a mortgage loan, is a shallow dive. And what I mean by that is you can be really termed pre-qualified by simply getting in touch with a mortgage broker or direct to a bank and talk to the mortgage officer at the bank, either one. And you can go through a pre-qualification process whereby you will, and back in the ugly days of the Depression, you could just state your income, which is pretty scary when you think about it. And you wonder why we had a financial collapse. You could just state it, and a lot of people just made it up and they lied. But now, since the Great Recession, you really have to go in there and document and prove your income. And they're going to take a look at whether it's your W-2s or your 1099s, depending on whether you're an employee or an independent contractor and any other sources of income. And they're going to look at that. And they're also going to look at the best barometer they have to see if you're credit worthy, meaning will you pay this back? Do you have a history of paying back loans on credit cards and car payments, whatever it might be? So really, that's where it can begin and end for pre-qualification, whereas the bank says it's reasonable. Now, of course, the bank or the mortgage broker, they're going to give you a pre-qualification letter with all sorts of other contingencies because they're not going to put that in writing that you're fully pre-approved. And the reason is, the second point here is that underwriting and the process of underwriting this loan and the underwriting department is all the final authority in this. And that's a process. So it's almost like that first event. Okay, why don't you send me over your W-2s or 1099s and I'm going to pull credit just so you know that's okay. Is that okay with you? And they get your approval, right? And okay, this looks reasonable to buy a house in the XYZ range that you're looking. So it's really just almost like an initial diagnosis, like a doctor. It's a reasonableness of probability of success or not. And so now, let's say you get through that phase and you go out and shop and you put something under agreement by making an offer. And in that offer, look at smart buyers. I would always tell you, look, I just really get nervous for all of you dropping a mortgage contingency when you actually need one. I don't know why you would do that. I don't know why you think you need a property that badly that you would take that kind of financial risk to put probably what is a pretty significant deposit at risk. Why? It's hard enough to make money, save money, and then to put it at risk like that is just foolish. And that means you're probably caught up in really the frenzy of a hot market. My best advice personally as a longtime advisor, fiduciary to a lot of buyers, don't do that. There's always another bus that comes along that's not going to force you to do that. In fact, if you have a really good agent who digs in, we'll find you some off-market properties where there's not a frenzy. So that's how you protect yourself. But now let's get into underwriting. Well, what do you mean by underwriting? Well, what happens is you go make an offer. And the reason I just went through that diatribe about protecting yourself is because one of the contingencies in the offer that you should have in there is that you have a mortgage contingency. So remember, you got pre-approved, and you oftentimes the seller's agent will ask for the pre-approval letter, and they just want to see that you've begun to fog the mirror, right? Have you actually gone through the steps to be diligent, because you're asking my seller to take the property off the market while you go through this process, which is now a risk to my seller. My seller has market risk time, and especially in a marketplace, as I'm recording this, the market is beginning to correct to the downside. So sellers have tremendous risk if they have to come back on the market in 45 days, 60 days, when you didn't get the mortgage, right? So the pre-qualification, and then a smart seller's agent, listing agent, will pick up the phone and actually call the mortgage broker or the bank and say, how deep is this? How far have you gone with this person? And really agitate that conversation and try to get that loan officer to really make the case that this is a decent buyer, right? So I think that becomes a very important understanding. And now you go and you put the mortgage contingency. How long does it take for underwriting is a question that you really need to ask the banker. Say, once we put something under agreement, how long will it take me to get the appraisal, then get to the point where the appraisal's been reviewed, then whatever underwriting wants from me for additional financial documents, maybe more historical documents, maybe more proof of income, whatever it might be, there can be a lot of moving parts depending on how sophisticated or complex somebody's financial history is. So you're going to get a lot of those additional requests during that period. So that's not something that happens overnight, because we have people involved, and some of those banks don't have the fastest processes. So really, let's just say it takes 45 days, right, to be safe, 30 days. I know some lenders are really pressing it because they have a good system. They say, we can get you fully underwritten in 2 weeks. Oh, okay, great. If they have that kind of command over everybody, including the appraiser, to get out there, get in there, with the schedule, get the appraisal back to them, that's tight, really tight. So the reality is, from the purchase and sales agreement, typically what I see in my business is that it's about 30 days from the purchase and sales agreement, which isn't the date we start with and go 30 days out. We have a contingency period for home inspections. And home inspectors have to be scheduled, and you have to get in there, and then you have to get the feedback and maybe renegotiate or withdraw from the deal, depending on how egregious the items are that come up. So there's that process. So underwriting is really not even going to kick in until that's over, because why should they? What if the deal falls apart and they already have mobilized their people, including ordered the appraisal? So appraisal costs you, the buyer, money, unless, of course, the lender has, picked it up, or when they don't pick up anything, they roll the costs in. Let me just tell you that, okay? So into the rate or wherever they hide it in what they do. So what happens is there's a process of time. And in that 30-day period, see, in Massachusetts, and I won't speak to every state or country, where the tradition more so is that we go through two contracts. One is called an offer to purchase, and it has multiple contingencies, not the least of which is there will be a signing of a purchase and sales agreement, which goes a little bit deeper. And in Massachusetts, the purchase and sales agreement is definitely a more complex contract that gets into title and clean title and a lot of issues, because we're not just talking about the property, we're talking about the title. Is the title insurable? Is it a good title? Because you're not just buying the physical property, you're buying the title to it. And all that has to be thought about and reviewed. See where I'm going? Not quite as easy as you think it is. So you want to appreciate that and understand that this underwriting process, we have to have an appraisal that comes in that says this is a financeable property. I mean, you want to pay $1 million for this property, but it only appraises in a sliding market at $850. You have a problem. You have a problem because the bank is, pulling in their horns. They're not as aggressive. Markets keep going backwards, and their appraiser is trying to be very, very specific on where the market's at right now, not where it was 2 months ago, 6 months ago, right now, because they have to protect themselves in an honest, ethical way about what they believe the value is from a financeable standpoint. So that could be something that comes back that has nothing to do with you and your financial ability. It could have to do with the property itself. Now, you have to make a decision whether or not that they're only going to lend you, for example, 80% on 850 versus 80% of $1 million. You can do, the math on the difference in what you'd have to come up with in cash. Well, that might hurt you. Now, all of a sudden, you're chasing a property and you're digging into retirement accounts. Don't do this, folks. Don't do this. Be financially smart. Be financially stoic. Right? Don't get that emotional where you just in the heat of the moment make these crazy decisions because underwriting came back and revealed something to you that you didn't understand about your own situation financially or the property. So the key point here in this podcast today is never assume that you're fully qualified to purchase a property until you and the property have cleared underwriting. I mean, it's like a marriage. It's your financial capability plus this value of this property, plus the title and all the legal that goes with it. It's a marriage of this whole package of information. And underwriting is there to protect us in this economy from these egregious things that have happened in the past. And that's why the underwriting process is extremely difficult since the Great Recession. We don't have the financial risk, at least in the mortgage-backed securities business that we once had, because the people that have had to go through the process understand how difficult underwriting has been. Underwriters have been very diligent in asking for a plethora of extra documentation. So expect that when you go through this process, and don't rush. This is one of the largest financial and emotional transactions most people make in a lifetime. I know some of you will listen to this and say, but I know, and this doesn't relate to me. I'm cash. Well, I have a little note for cash buyers too. Decide how much cash you really want to spend. Don't just go out there blindly acting that in the fact that you're wealthy. You want to make a smart decision like a bank would be. You are your own bank in that case. You are your own banker making decisions. So there's your caveat for your cash buyers. So let me go back and summarize. We're in the buyer plan of our 3 plans. And the question on the table is, what's the difference between financial pre-qualification for you as the buyer and full loan approval? So the first point was to understand that pre-qualification can be a very shallow dive, very shallow. It's just a quick cursory look to see if it's a high probability of success. But the second point is that underwriting, the underwriting department is the final authority because they are going to do their due diligence and they're going to rip you apart financially and the property to make sure this is a viable financial situation going forward. And the key point here, point number 3, is that you should never assume as a buyer that you're fully qualified to purchase a property until you and the property have both together cleared underwriting. All right, you'll often hear real estate agents ask if the buyer has been pre-approved. We should clarify that pre-approval or pre-qualification is at the very beginning of a full process of underwriting, and not only the buyer's capability to borrow money and pay it back over time, but also a question of whether or not the property itself has enough appraised value to even merit the loan. Never assume anything until the underwriter says the magic words, clear to close. Okay, remember, you can take immediate action to get started in the right direction. If you are a seller or a buyer trying to buy a residential property, or maybe you're an agent who wants help, all of you can get help from us for free, no obligation. I know that sounds like corny words, but it's true. Test me. Go over to griffincourses.com, Griffin courses.com. There are free digital plan copies right there. You can get instant access and you can listen to me chunk up the full plan. These are little bits and pieces of it. There'll also be an opportunity if you want a physical copy of the plan. You can ask us for one of those and we'd be happy to mail it out with some other goodies that really get you started in the right direction. Okay, also don't forget you can subscribe to this podcast on iTunes, Spotify, or wherever you listen and this syndicates. We also post, he said, our content on our YouTube channel. So don't forget, you can find us over at The Griffin Channel. And you'll see all of our buyer seller plan and other videos over there that you can, if you're curious and you want to learn more, just curious about real estate, jump over there on YouTube. But we'd also appreciate it, of course, if you would share this content with home sellers and buyers or real estate agents that you know who might need a little extra help, might need a little extra perspective. And again, no obligation to do anything with us, but just education for free. It's what we believe in at this company. Give it away. Give away your best what to do information for free, and the rest will follow. All right, remember, nobody's coming for you. Nobody. So take action to get work on your plan for buying, selling any kind of property in residence, right? Or maybe you're trying to become a successful or better real estate agent. Nobody's coming for you. But we will be here in the next episode to help you keep thinking through this and working on it. But in the meantime, we just appreciate you listening. Thanks.